Hello, everybody. This is Jake Stanzano, host of Jake and Gino podcast. I'm here with my co-host, the multifamily mentor, the coach, chef, father, six, the best-selling author, the G Daddy, Gino Barber. How's it going?
Jake, I'm doing good. Sitting next to you today. How you doing?
It's a little awkward, but we're making it happen. Very special guest today. Today's guest is the CEO of John Burns Research and Consulting, a company he founded in 2001 that specializes in independent, unbiased analysis of the real estate industry. And that's, Gino, that's why we love it. That's where we get the data from, right? And for more than 27 years, he has helped executives like ourselves form demographic-based strategies. So without further ado, John Burns, welcome to the show.
Happy to be here. I don't talk as fast as you guys, though, so I may slow it down a little bit.
I'm an 80s kid, and I don't know if you remember Micro Machines, but that's where I got it from. So we'll just let it rip.
Yeah, I guess we moved a little slower in the 60s.
That's all right. Well, you know, those drugs that caused that, but we won't talk about that today. So
I wasn't doing drugs when I was 2 years old, just to be
fair enough. John, let's get your background, if you don't mind sharing your story and how you got started in business.
I went to undergrad, got a degree in economics. My dad was a CPA, so I went and did the CPA thing for 2 years, went back to grad school, joined KPMG's consulting practice at the time. It was a generalist practice. My boss, they reorganized the company by industry. My boss picks real estate, and so I end up as a real estate consultant starting in 1989. Working on commercial real estate, golf courses, hotels, housing, everything. And then I left there in 97 because I recognized, well, I really left there because I was traveling too much and started a family. But then in 2001, I recognized that the people investing in housing were not nearly as sophisticated as the commercial real estate guys. And so there was an opportunity to bring some of that commercial real estate sophistication to the housing industry. So that's why I started the company in 2001, and it's been a good ride for 21 years.
John, what keeps you up at night about this current real estate market?
Well, I've got 130 employees, so they tend to keep me up at night. But other than that, it's really what I don't know. And there's always so much information I don't know. And going back to the start of the company, it was more like there was no good information out there. Can you go find it and figure it out, John? And now there's way too much information. Can you synthesize it for me and get under the, what's good and what's bad? Or, there's plenty of good data that is being interpreted negatively by one person and positively by another. So we try to bring balance to the whole thing so people don't have to spend their entire work life figuring out what's going on in the market. That's what we do for them.
So John, Gino and myself, not nearly as sophisticated as you. We like apartments. We invest. We own 1,600 apartments because we know it's a basic human need. We keep it simple. We like high growth areas. What was the gap at the time that you mentioned just a minute ago from the commercial real estate guys and the level of sophistication that you saw versus today? What was that gap that the commercial guys were using versus, say, the multi-family home owners?
Well, the biggest gap was, first of all, they had it easy because they were owning big, huge buildings that didn't change very often versus housing industry, particularly the home builders. You open a new community, you sell out, you move on to the next community. And, small apartments all behave pretty differently too. So the apartment part of housing was more sophisticated than the for sale, if you will. The other thing was that the housing people just tended to be deal junkies, moving from one deal to the next, whereas the commercial real estate companies were mature, run by, highly educated people. They were super smart. They're fine-tuning every basis point of interest. And housing was just more of a deal junkies business, if you will.
Mm-hmm. So for those of you that haven't heard of John Burns, I don't know where you're hiding under. Go to LinkedIn, check out his stuff on LinkedIn. He's got tons of followers. The posts that he makes on there are amazing. He sends out a newsletter. Make sure that at the end to subscribe to his newsletter. Before we go on, John, where can the listeners get your newsletter?
Well, we just rolled out a new website last week. Actually, it's jbrec.com for John Burns Research and Consulting. And you can sign up for free there. And there's a boatload of content. I think there's 17 years worth of history of newsletters on there as well.
And what I love about it is every week it's something different. One week you'll talk about construction costs. One week you'll talk about the build to rent model. And what I love about it, whether it's people rehabbing their homes, all of a sudden, how's that tied into inflation going on? You still didn't answer the question though about the real estate market. I know the employees, my kids, I got 6 kids, they keep me up. But what are you looking at as far as the real estate market and saying, there's a little bit of problems over the horizon with that.
Well, the question you asked was what keep me up at night, and it was like what I don't know.
Uh-huh.
There's a lot I don't know. How we do a couple conferences a year, and our upcoming conference in May, the two things we're focused on that we don't know is where interest rates are heading and what government regulation is going to do, because it's pretty likely they're going to overreact to what's been happening in the banking industry. So we brought in Jim Grant, who's the one of the foremost interest rate people out there. We brought in Mark Calabria, who regulated Fannie and Freddie, to tell us what he thinks coming forward in regulation. So those are the two things I think we're paying most attention to right now: regulation and interest rates.
In one of your articles, you were discussing how many apartments are coming out or in the pipeline right now. Can you discuss that? Is that going to be an issue in places like Nashville, in Phoenix, and maybe Charlotte? There's so much inventory coming online because I know the supply chain really pushed them off and it took them a lot longer to complete. How do you see that working out?
Um, well, it's definitely an issue, and particularly if the Fed gets their way. So if you study the history of the apartment market, they cycle very hard based on the health of the economy. And right
Hmm.
now, the economy is doing fine, but the Fed is hell bent to create a recession, to stop inflation. I mean, it's in their forecast. They don't use the R word, but they are forecasting that unemployment's going to go up by almost a full point, which is a soft landing. And if you talk to anybody who's opened a 200 unit apartment complex when there are job losses in the local market, it can get pretty damn ugly. So
Hmm.
that's what we're paying
And that's
attention
when the apartment owners get caught, right? I want to be specific for
to.
the
Right.
listeners out there. When unemployment rises, that's when you have to be nervous as an apartment owner, because then people cannot pay their rent. And it's usually at the back end of a recession. So that may be the issue that's coming ahead. Correct, John?
Yeah, and said more succinctly, even there will be fewer people with jobs in your market.
Yes.
So if there's fewer people with jobs and you're adding more apartments, that's a bad combo. Now, some of the markets you mentioned, though, I mean, investors aren't stupid. They're building all these apartments in the great growth markets. So those markets should fare better in a recession than others. We are definitely in a tech recession right now. So I think Austin is highly exposed because it has a lot of tech employment. The San Francisco Bay Area is very exposed. Phoenix is less exposed to tech, but I think Phoenix is ground zero for speculative investments, for home flippers and iBuyers and everything else. And a lot of entrepreneurs live in Phoenix. So you've just seen a lot of speculation there. You mentioned Charlotte, though. Even though Charlotte is a banking sector and banking employment, the economy there is so far is doing okay. So it really, really, really is a local market. And even when you drill down into it, if those 200 apartments are on the other side of town, you're probably fine. But if they're right
Hmm.
across the street from you, it's incentive wars, right? And it's free
Hmm.
rent wars. And I run into a lot of people, particularly that listen to podcasts like this and go, oh, that just impacts the new guys. They're at $3,000 a month of rent. That doesn't impact me. There is a total trickle down effect because somebody paying $2,000 a month in rent realizes all of a sudden, hey, I can get a much nicer apartment for $2,000 a month. It impacts everybody.
Hmm. Hold on one second on that. And I want to be very specific with that. It's the lease up period. When these new apartments come online, typically there's deep discounts that they're offering to get people in the door. And that's the trickle down effect that John's talking about. That impacts the entire market. Eventually they'll have to raise rates or they won't be able to fulfill their debt. But there is that option when they first open up, and you're talking a 300 unit apartment complex, that will affect a local economy in a big way.
Yeah, and you said that pretty optimistically too, because some of them may not be able to fulfill their debt. I mean,
Yeah.
we talk to a lot of lenders on these that are pretty damn concerned.
Yeah.
um, and a lot of the debt here is adjustable rate debt, and we know what's happened to rates.
Well,
Mhm.
that's the issue right now is the bridge debt, but there's actually good debt out there still in the agency world. It all comes down to your loan to value. We just got off a call with our broker and we're, looking at 4.7, 4.8, but we're 55% LTV right now and many people are not as fortunate if they're looking to do a refi right now to agency. So the LTV is where people are getting caught. And if look, you're high LTV or you're a bridge right now, that's where the risk comes in. So I completely agree with that. Yeah.
So you guys are closer to this than I am. So what's the typical LTV in terms for a typical 200 unit apartment complex for most people?
So it all depends. That's why people, well, I'm going to actually back up even further and where the issue originated from was last year. People were not able to get a lower LTV on a stabilized deal. So people were using bridge debt to buy stabilized deals because they wanted to get a better LTV. And that's where the bubble is going to be created from 2021, 2022. They're using bridge debt to do a stabilized deal, claiming value add when they shouldn't have applied that. They should have done a 30, 40% LTV that Fannie was requiring on that deal to make it work because the prices had elevated. That's where the issue is going to come in on all this.
Right. I just looked at a deal last week where somebody used mez debt at SOFR plus 10 and a quarter. So
Yeah.
basically a 15% mez debt.
Yeah.
So I mean, and I don't know what the LTV was on it at the end of the day, but that's where the issues arise.
Yeah.
You
And
wrote
you
an
want to be
article
the
of
lender in that scenario, man. You're making a 15% return.
Until you get it back.
Well,
That's that's a boomerang. Okay, that's what we call boomerang, John. That one's coming back to you.
I call it loan to own.
Like that. You talk about the recession, and in the article, I forget exactly the numbers, but you said 2 to 6 quarters for the Fed basically once they start raising rates, and it only hasn't happened for 2 times in the last 50 years. And we talk about market cycles, but you really should be talking about the interest rate cycle. When you see rates going up, they're trying to control inflation. That's what they say the job of the Fed is. They took too long to do it. Then all of a sudden, like, oh crap, I got to do it. So let me do it within a span of 6 months, which should probably been a span of a year and a half to 2 years. But discuss that and let's educate the listeners on how this is going to happen again. This is just part of the cycle. So what do we do for the next time to prepare ourselves for this? And how can we forecast that, yeah, there is going to be a recession going on in the near future?
Well, I mean, you don't know for sure, but the Fed is trying to. I mean, they're just trying to kill inflation, and our industry is a great example. So rates have been rising for a long time, but it hasn't created a lot of distress yet.
Mm-hmm.
So but these loans will mature over time, and it will create distress, which will cause companies to have to slow down and stop laying people off. The prime rate, for example, that companies borrow against is now up to 8%. So if you're running a company and you're a prime borrower, you were borrowing at 3.5, and now you're borrowing at 8.5 probably. You're just not going to hire as much. Maybe you're going to slow down, and that's what the Fed is trying to engineer. They're hoping they do it in a way where everybody slows down and we don't crash. We'll see.
There's a bigger issue out there when it comes to community banks because of the SVB issue. So much money was sucked out of the local community banks and put into the top 5 or 10 large banks for security purposes that now the community banks, and we're experiencing this with local banks that we typically would acquire a deal with, their deposits have shrunk so much that in order for them to do a new loan, they're going to have to borrow money to actually make that loan. So their rates are, to your point, 7, 8%. So they're not going to be able to actually do new loans because people don't want that type of debt. Or if they do, the money's going to get much more expensive.
Or
So
prices have to come down.
or prices have to come down. So that's the next thing that's on the horizon that we're not even seeing or talking about yet. And I think you're talking about the Fed a lot as well. A lot of these rate increases take 6 months to work themselves through the economy. So we're only starting to see that. So no one has a harder job right now than the Fed trying to have a soft landing, if you will, because by the time it hits the street, it may be too late because it took 6 months to get through. And then it's like you have to pivot back. So I, for one, am pretty nervous because I think it's an extremely difficult job, and I don't think it's a perfect science. So we'll see kind of where this roller coaster goes.
No, I mean, there's 130 million employed people in the country. How can the Fed know what's going on in every
Yeah.
single business? I mean, it is impossible. But you mentioned it. You mentioned we reported it's 2 to 6 quarters usually that it causes a recession. We're now four
Mhm.
quarters in.
Yes.
I think they started with a stronger economy, so I think this one would be a little bit longer. We've been calling for most likely the end of 2023. My definition of recession would be actual job losses. The technical definition of recession could happen sooner than that, which means the economy is growing at 3%, but inflation is 6. So that's, 3 minus
And you
6 is
saw that
8.
last year. You had 2 quarters of
Yeah,
negative GDP
right.
last year.
But
So
nobody
yeah,
cared. Nobody.
yeah,
I mean, when
they did
you
not.
well, what happened with all the deposits going back is when you distribute as much money as they did, people stuck it in the bank. So the
Yeah.
deposits went up. So the deposits have been coming down for a while, but the
Mhm.
banks were lending with those deposits, right? They needed to. So the deposits have been coming down for a while, but then you had a couple banks that just over concentrated in one sector, maybe put too much of their investments in long-term interest rate bonds
Yeah.
and securities that when rates go up, they fall in value. And that's what happened to SVB and Signature. Um, but it's nobody knows for sure what their local regional bank did. Nobody can study their balance sheet very well. So they're concerned and rightfully so. And
You
and
also
the banks need deposits to make loans. So the even more interesting issue is where are they going to get the money to make you a loan when the
That's why I'm
deposits
saying
don't
it.
go
I'm fearful that the local community regional banks are going to be in big trouble going forward, and it's going to be something that I think is going to become more talked about because we have a relationship with those types of banks right now. We work with them, we use them, and we know by going in, we're doing a deal right now. The bank that we use much of the time said, we don't have enough deposits right now. We have to go out and borrow money to make a loan. So, and our response is, well, we don't want that, you know, debt because it's too expensive. So they're not going to be able to lend. So I don't know. It sounds like somewhat of a death spiral to me, and it's going to be interesting
Well,
to see
it's
where it
not.
goes.
I wouldn't call it a death spiral. It's exactly what the Fed wants. It wants you
I
not to
don't
be
know that
broke.
they want that. I think that may have been an unintended
No, I think
consequence
they
of the
do.
SVB. I
I
think
think
they want. I think they want the economy to pull back. They want inflation to slow down. They want there to be higher unemployment. I don't think they want a death spiral with the local regional
no.
community banks.
They don't
That's
want
what I
a
meant specifically. Yeah.
they don't want a death spiral, but they don't want you to grow your business. They want you
Yes.
to stop. So
Yes.
so
I
what
think
the
that's completely fair. Yes. Yeah.
bank.
So I'm an optimist. I'll be the optimist now. I like capitalism because there will be other ways. We see credit unions stepping in. That's what happened in 2015
Yeah.
with the Freddie SBL. Community banks were getting a little sloppy. There was less margins for us to borrow. All of a sudden, another product came out.
Mhm.
That's what's going to happen. And I think hopefully, I don't know what the product is, but all of a sudden, credit unions 2 years ago, no one really used multifamily for credit unions, and I think
Yeah.
that's
Another
awesome.
stepping up for sure.
Yeah.
Yeah.
John, I'm going to ask you about construction. How has the construction been affected by the spread of SOFR? You write about that, and was an excellent article that you wrote about.
Well, construction needs to slow down. The for sale industry has slowed. The apartment industry has hardly slowed at all. We talk about lag. Most deals really were funded a year or more ago, and people are still moving forward. And the leading indicator in apartments is permits, not starts. So watch the permit number, and it's trailing down, but off of very, very high levels. So you're not seeing relief in construction costs because there's still plenty of demand for materials for the most part, not every material. But I think housing is the lever the Fed can control because housing is very interest rate dependent. So
Mm-hmm.
they goosed the economy by dropping rates and helping our industry kick some butt for a couple of years, and now they're doing the opposite. So
He just
we
said the
just
party's over, Gino.
no, the party's not over. Actually, if you want to be an optimist, the party's just getting started. I mean, if you just hit pause, focus on your balance sheet, and there should be some great investment opportunities coming your way.
We're actually more active now, John. To be completely transparent, we're more active now than we've been over the last 2 years because we don't raise capital. We actually do all our deals internally, so we're more selective when it comes to price per unit and whenever we're using our own capital. So we've been more active in the last few months than we actually have the past 24 because we've seen prices come down and it's become more attractive to us. So
Do you
to be
think they're
fair,
going to come down some more, or do you think they've hit the bottom?
I'm not I don't have the genie in the bottle, right? And so I don't know for sure.
So I think what's
Yeah.
going to happen is those that have to sell that aren't operationally efficient, that don't know what they're doing, they bought because they thought it was a passive activity. Those are the ones who are in trouble. And we're actually seeing deals that 12 months ago would have been priced 10,000, 15,000, 20,000 per unit more. But now they've come down to the realm of possibility where this deal could work.
Yeah.
If rents do rise in the next 5 years, where we're projecting, that deal actually can make sense today. Whereas a year ago, there was no shot in hell that deal, at least for us in our underwriting. So to us, that is the optimistic part. But John, you're saying construction has to slow down, but don't we have an affordable housing crisis? Don't we have? I mean, the '08 recession basically grinded construction to a halt for a few years. Then we started ramping up, and in 14 and 15 started building. It's only caught fire the last few years. We're going to slow this thing down. What's going to happen to housing prices? Because there's no supply. There's still going to be demand there. What happens with that dilemma?
Yeah, I mean, we did a big white paper on this for our clients a couple months ago. We actually looked at it by geography, and the data
Hmm.
is not perfect, but the vacancy in almost every market in the country right now is tighter than usual. The number of adults in every household is a little higher than usual. So you can definitely conclude with a lot of confidence we're undersupplied. However, because of that, rents grew much faster than income. Home
Hmm.
prices grew much faster than income. So the mistake I hear all the time is like we're undersupplied, so we should be fine. We're undersupplied at apartments with lower rents, and we're undersupplied with houses at lower prices. The market has cleared, and I think the more rents come down, or let's say it another way, grow less than wages are growing, and the more home prices do the same or interest rates fall, the more of that undersupply can be satisfied by people that can actually afford it.
Build to rent. That's been the hot topic for the last few years. What are your thoughts on the build to rent model?
I mean, we were very, very, very early on in that,
I
to
know.
the point where people called us out for being stupid. That makes no sense. But we would have done that. I'm. I'll say it real optimistically. I think every city in America, even small suburbs, need at least one brand new rental community in them of either detached houses, or some of these kind of look like horizontal apartment complexes, just single story apartment complexes, because there is a market for all the tens of thousands of people that rent. Someone will pay a premium for something new that is lower density, that has a yard for my dog, that has a attached garage. I mean, the garage is probably the biggest amenity that compared to an apartment complex. Um, so we're super bullish on it. That said, it's had entitlement challenges. Cities don't understand it. So certain cities that have figured it out have allowed it to happen, and I think a few of those cities are getting oversupplied as we speak. But I think that is a big booming business, that we're in
But
the.
there's optionality there as well. So if you needed to sell, a lot or two lots off, or the homes in that way, it gives you optionality that a traditional 200 unit apartment complex does not. So I think there's other means where if it did get tight, that you could go and sell them to someone wanting to live there. No.
Um, Yeah, although interestingly, a lot of the cities and even the financing, like the multifamily financing, you only get it if it's a multifamily plat. I mean, they're struggling to have, like,
Mm.
they can't give you a multifamily loan when you've got to put a deed on every single property. Um,
Mm.
so
If you're saying if you're using like an agency type debt on there, like
right,
Fannie
right.
Freddie.
If you're not
Yeah.
using
Yeah.
agency debt, it's more expensive debt.
Yeah.
Hmm.
Because it's the single family world that's trying to figure out, how do I loan to an investor.
Yeah, I think it's the first few years though, while it's being developed, you probably don't have an agency deal on there. I guess is what I'm saying. So it all depends where you are in the cycle, but yeah,
John,
it's
let me
fair.
ask you: when you're building this, what is a typical build to rent? What do you like to see in a number of bedrooms, square foot? What is the typical, uh, I guess,
I mean,
parcel of length?
well, we spent a lot of time on this because there are different segments.
Mm-hmm.
There are what we call horizontal apartments that are more like a single story triplex, uh,
Mm.
with a garage that's detached, maybe even a carport. That feels very much like an apartment. Those are very small units. People will give up their 900 square foot apartment to go get a 700 square foot one of those. in order to have nobody walking on my ceiling and a place for my pet. On traditional houses, it tends to be higher density. Most in most areas, I can think of a few exceptions. People won't pay much extra rent for a large yard. They're happy. They just need a small yard. So you see a lot of high density, like 10 to the acre type, 12 to the acre type detached homes. A lot of those 2-story. Probably the most successful over decades. There's a company called Redwood Living that started this in the Midwest 30 years ago. They've been doing paired townhomes there forever. It's got a big driveway. It feels like single family living. It's 200, traditionally it was $200 more to rent than in an apartment. So it was very affordable. Huge demand for that. Huge.
Mhm. Let me ask you about all of these municipalities in these cities complaining that these hedge funds are buying up these homes. How has that affected the market, and how do you see that going forward? Because they want to put legislation to stop them doing it, and I'm like, just let the market work itself out. These companies will lose money. They'll have to start selling their homes. What are your thoughts on that?
Well, we actually have all the data on that. It's getting a lot of headlines. I mean, the
Hmm.
institutionals that own 1,000 or more units are a very, very, very small percentage of the market. It's mostly people like you that are doing this. Um,
Hmm.
but it's great. It makes great headlines for politicians. It makes great stories for the New York Times and Bloomberg. So it's very, very overrated. In fact, I'll even tell you, we just got some data on this. The big guys are buying 80% less than they were a year ago. The small
Hmm.
guys are buying about 15% less than a year ago
Why are the big guys buying less?
Cost of
because
capital.
their borrowing costs have gone up.
Yeah.
The private big guys tend to lever the heck out of it. The small ones are publicly traded REITs where where their stock prices have plunged and said, we need to buy assets with higher yields. That's become infeasible for them.
Yeah.
Wow. Let's take a quick time out to hear from our sponsors.
Jake and Gino's Multifamily Mastery 6 is coming to the Gaylord Palms in Orlando, Florida this October 14th and 15th. Join Jake and Gino as they welcome special guests like Chris Voss, Luke Wren, David Green, and many more. Discover Jake and Gino's 3-step framework for real estate success, enabling students to accumulate $4 billion in assets. MM6 is the multifamily event of 2023 that you do not want to miss. Go to jakeandgino.com/MM6 to reserve your tickets today.
All right, we are back. Now, John, you said something very interesting early on, and you were calling the developers and the people that were doing a lot of single family home stuff deal junkies. Now, Gino and I have talked about this for a long time. What would you say to the deal junkie developers out there that they build the 200 unit tract, they sell it and move on? Isn't there real value in holding these things or maybe doing a build for rent model that the real wealth can be created
Um, well, I mean that's deal junkies don't hold for the long term. But I think deal junkies need to pay more attention to the cycle because there is a time in the cycle where everything looks great and you want to put all your chips down, and there are times in the cycle where you take some chips off the table, and that's what we've started, and that's as a very simplistically, but that's what I founded my business on. It was more about assessing the risk in the market right now. And you talked about it earlier. I mean, you guys are doing lower LTV deals because you can see the risk in the market. There was a time a couple years ago, and there'll probably be a time a couple years from now where you'll be very comfortable levering the living heck out of things because you're getting a great deal on it.
in? Hope so.
But John, that's the definition of a deal junkie. They can't help themselves. They don't care about the market cycle. They're doing deals because
Yeah.
they've done it before, and they're just going to push all their chips in, and they're going to go, I got unlucky this time. It has nothing to do with luck. It has to do with experience, and it has to do with the market cycle and understanding when to hold them and when to fold them. At least that's how I perceive
Well,
it.
that's what started my business. Is I saw some of my clients make a fortune and give it all back. And when you give it all back, you end up with divorce. You end up with all sorts of crap, and that's what I've seen this industry do over time. I think the industry's gotten far more professional, though. I think there's a lot less of that, but if you're just not going to pay attention to what's going on in the world and be an eternal optimist, you're going to lose it all at some point.
Yeah. No, Gino and I just talk about it quite a bit because I do think that there's so many opportunities for especially these developers that have built large apartment complexes or a large build for rent community, build to rent, and then they've just sold it off. Where if they would have held some of this stuff, they wouldn't have to work so hard. They wouldn't have to do so many deals, and that's why we typically hold all of our stuff unless there's something about it. The market has shifted in terms of maybe there's like a demographic shift, income has gone down, or the area is not as safe as it used to be, something like that to cause us to want to exit. But if we call it our buy right criteria, if we typically nail our buying criteria on the front end, keep our loan to values at a reasonable, what we believe a reasonable rate, we like holding these things for the long term. I think that's where the real wealth is created. And I think so many developers miss out on that. So something we kick around. And that's why I was just, kind of hearing from you on that.
I very much agree with that. And another thing to mention is that you've got a steady cash flow business while you're taking risks doing other things. That's a good combo.
It's like, well, look, you're not investing in this. Like him and I don't have jobs, right? We invest in apartments. How many people invest in the stock market and that's their job? I know people do because they get paid fees, but not because of the dividend that they earn on it. And that's why we love multifamily so much. Where are these tech workers going to go? Because I'm seeing, I think, hundreds of thousands, correct me if I'm wrong, of layoffs happening in the tech space. Where are they going?
There is such a shortage of talent right now that they're all getting jobs like that. So, and I think that's part of what the Fed.
Well, we saw an uptick in leisure and hospitality. I don't think an executive from Google is going to work at the local Embassy Suites or DoubleTree. So that's where we just saw the jobs go, which has been needed because restaurants and hotels have been so drastically underserved from a labor perspective. So I don't know that that's where they're going, but I'm sure they are finding somewhere to go, but I don't know where that is. So.
Well, the guy cleaning Google's office building may end up doing that, and then a lot of those tech execs are ending up at real companies that have stable cash flows and just need more tech talent. I mean, talk about change in the world right now. There is a lot going on in tech, a lot, and businesses need to figure it out. And all those people that are getting laid off have the talent to figure it out for real businesses, so they're getting jobs.
Like yourself, starting as a CPA, this is what I hear from you. Going from a CPA to an entrepreneur, talk about scaling to 100 employees because I'm sure that wasn't taught to you in college. Any war stories or learning lessons to share with the folks there?
Yeah, my father, the CPA, thought I was nuts. You can probably tell I'm a pretty risk averse person. So starting your own company sounds pretty risky. But I've grown slowly over 21 years. I never borrowed a penny. I never took on a partner. I have a research business, which is my stable cash flow, and a consulting business, which is very profitable, but can be pretty cyclical. So that's the analogy you've got to doing deals that are cyclical, but having a stable apartment portfolio. I'm very much in the same camp, and I'm playing the long game, and it's working out for me.
Excellent. Any book recommendations or anything that you've read recently that you want to share with the folks that's added value to your life?
Oh, so many. Related to you, Howard Marks has written a couple books on cycles. He's the founder of Oaktree. I've got some of them on the bookshelf behind me, but I would read some of his writings. One's like The Most Important Things, I think it is. We gave copies of that to our clients about 8 years ago. And it's obvious, but Warren Buffett's writings, which really aren't books, but it's the same thing. It's like, the market values go like this over time. And when they get too frothy, people get greedy and you should be cautious. And when people overreact and everyone's running away and you've got cash in the bank, you take advantage. And both of them basically are those are guys that are pretty financially successful. So I would recommend those two.
Well, the funny thing is everyone attributes this flywheel concept to Jim Collins from Good to Great. And I think Warren might have been touching on it early on with the snowball effect, because I think it's very similar there to describe that. But he's been great, and I completely agree with that. So give us one more time the new website, because I know you've had a rebranding, so folks know where to go and get more information on you.
John Burns Research and Consulting. It's jbrec.com. tons of free content there. We have a podcast we do every other week as well, and we have a boatload of contests for our clients. So we just kind of drip it out for free as marketing for us, and people enjoy that.
Yeah, well, I just want to say thank you. Your content is phenomenal, and the GDAD here is going to wrap us up.
So John Burns went to college as an economics major, and his pops was a CPA. So his pops probably rubbed off on him a little bit because the CPAs, they're not the best deal junkies, and they're not really great investors, to be completely honest with you. They just aren't, and they're not the types to grow organizations to 130 people. And what I admire the most is you're not looking at what anyone else is doing. You're comfortable with yourself. You're not outgrowing your infrastructure. You're providing tremendous value to others. And what's great about it, you're a visionary, because you saw that back in 2000, it was just disjointed. There was no information out there. Your clients needed to get that information. So how do you do it? So that's how you start a business, by providing value to others, not by trying to provide value for your family, but you're out there. There's a need in the marketplace, and that's where I'm here for, to create the need. And I've spoken to Chris and a lot of your employees. They all love working for you. You've created an amazing company, and I just want to tell you, congratulations, and keep kicking ass, John.
I will do my best. Thank you.
Gang, as always, we believe in buying deals for the long term. Think in decades. I'm Jake. He's the G Daddy, and we make it happen. We'll see you next time.